Day, ladies and gentlemen. Welcome, Crypto Sniper, Market Sniper, and the Reset Sniper. So this one is kind of in the latter, the Reset Sniper and a degree of Market Sniper. I'm going to start with the charts, but then I'm going to take you to some amazing news articles about what's going on. What am I talking about? I'm talking about Australia and New Zealand. And Australia, wow, Australia for a long extended cycle was the land of milk and honey, and throughout the UK's subprime crash, the States' subprime crash, the Eurozone issues, and the pig nations, all of these areas. I'm talking the last decade now, almost going back some time, maybe even a decade and a half. Throughout that period, the Australian dollar has been broadly appreciating against the likes of the pound and the euro, and even the dollar in instances, although there was a rush into the dollar, as we know, at the subprime crash, and there were fear. But particularly against the European nations, the Aussie has been getting consistently stronger. And when, in fact, we had the whole collapse of the subprime, the 0809, which lent particularly hard on London being the financial center, lent hard on Europe because of all the European banks that bought all the Detroit rubbish. They were the dumbest banks in the room, Deutsche Bank and the like, number of Swiss banks, Commerce Bank, etc., etc. And of course, the Eurozone crisis itself. All of these things were playing out. China consumed everything for the world and suddenly went from virtually no debt to extremely indebted and pumped heat into this, what essentially was a not admitted to entire depression, not a recession or the Great Recession or any other acronym or euphemism, more like. It was a depression. We are recovering from a financial depression. A depression is 2 years of negative growth in any economy, and also bank systemic failure. We had both. The fact that we masked in the UK in certain places an entire 2 years growth with a little fake 0.1 stats generated by a whole splurge of QE doesn't change the fact that it was a statistical manipulation designed to hide that fact. Very few people know that it's 2 years of negative growth for a depression. They don't want you to know the definition of a depression. They're okay with you knowing a recession. But so it was a depression, and China created heat, bought every commodity under the sun. In fact, during that period in QE, gold peaked out in 2011. Oil recovered after crashing right down in the subprime lows and everybody being so morbid. And in fact, oil is the Rockefeller tax, as I call it, where they skim off the wealth when you're having feel-good factor. So it goes up like a thermostat to keep skimming more money off you, because it's in everything. It's in everything you buy, the plastics, the transportation, the delivery of any items, whether it's a shopping store or to your door. Oil is in there. So that went really, really low. So the control structure wasn't extracting on that tax nearly as much as they typically do. And what happened is China was buying all the commodities. Then oil rolled and fell in 14 and had its big collapse from the $104 level all the way down and traded lower than the all-time lows. This was the beginning of the energy-based squeeze on Russia, which not only involved gas, oil, actually also involved yellow cake, which is uranium, enriched in uranium, which Russia had a lot of from their decommissioned nuclear missiles from the Reagan era that they'd been piece lot selling off into the States for nuclear power reactors that got crushed with Fukushima, etc., etc. So this was all trying to keep pressure on Russia, who in the meantime have been dumping the US debt that they happen to hold in their books and accumulating gold. Anyway, bit of a sidebar. But in all of this, Australia benefited from China coming in and creating heat in the economy and continued. They didn't have the same degree of turn down that the UK and the US had with the subprime sell-off. And in fact, they were doing just okay. And so to a degree was New Zealand. New Zealand slightly more soft commodities, Australia more clearly on the hard commodity side, ores and rock you pull out the ground, essentially. And so they continue to have low inflation because everybody was just keen to sell some stuff. Is there any demand out there? So prices were super low, low inflation. China was buying up all their commodities and really building out infrastructure into the next millennium, just about. We've all heard the narratives of the empty villages and the 8-lane highways with nobody on it, etc. So they were future proofing their their needs for infrastructure into the next millennium. So Australia continued, and the currency continued to hold strong during this period. Then there was the China Accord. It wasn't called that, but it's the Shanghai Accord. But it was largely by the likes of me and Jim Reikards and others deemed as such when China was so openly overdebted, their stock started to fall out of bed, and all the G8 guys came together. So what ended up happening is essentially Australia continued to do rather well, and their property boom continued to run. And in fact, per number of immigrants inbound to their nation as a percentage of wealth, they were having some of the highest percentage of net immigration, so their property prices continued to escalate. Yes, they're a big island, but that big red sand bit in the middle, most of it goes on around the edges, and as a result, they've continued to say, it's different for us. It's different for us. We have this amazing lifestyle. Our property boom will never bust. And what's ended up occurring now is we've been seeing for a while weakness in both the Australian dollar and, in fact, the New Zealand dollar as well. Now, in New Zealand's case, they've taken more dramatic steps a little quicker. They're a smaller island still, and they banned all foreigners from buying after they were the spot for billionaires who wanted to sit out the reset someplace far away from where all the Scuds and the intercontinental ballistic missiles will go in the event of World War III. Unfortunately, this has become a heightened likelihood with a financial reset, and the suspicion towards the control structures, big game, is there. Anyway, so with this whole reset narrative, what is going on? Well, it's my express view that Australia, the Aussie dollar, is finally due for some big corrections. This is what we call an inverted HVF. Our guys have been good on it. We had a primer, we had a small setup on it. In fact, we're seeing 711 over here, so more downside to come. It's just run an interim target, so it rallied. And this is the Aussie dollar versus the US dollar, and this is down just at a 30-minute level. But let's take you up into a much bigger time frame chart, and you might get a little bit of a feel for where I think we are at. We've had this grind rise against the US dollar. The Aussie at one point was supremely high. Then we had the crash of China. And the beginning of that sell-off. 2014, you had the crash of oil. Here we had the crash of gold and silver, 2011. So there was two stages to this. That was your first inverted HVF that smashed you down on a macro level to 14. That's after coming up. Look at the depths from which she comes, from the 4.7s to the dollar. That means less than 2 Aussies couldn't get you a full dollar. Upside HVF there. Then we had that subprime crash, which saw everyone run into the dollar, and then we very quickly recovered and made new highs on that. That was the supremacy moment. In fact, an Aussie was worth more than a US dollar, 1.11. Then you had your first inverted. This is the China heat moment. Then the first inverted, the silver and gold first capitulated and crashed. Gold, Australia's overtaken South Africa as gold producer. It's ahead of them. I think China is the largest now. But as South Africa's light as a gold producer's fade, Australia has stood up. And China stood up too. Then this roll down over here was the oil sell-off and the second stage of the commodity deflation. Following China pumping some heat in, they eventually were exhausted and indebted, and that saw the Aussie back down here. During this period, the Australian did this grinding channel rise. Now, in technical analysis on a big time frame, many may be tempted to call that a flag-like sell-off. Essentially, you have what is here a very, very massive sell-off. Now, I am not going to project that down. I think you get a number somewhere below naught, in fact, but this is not typically bottoming price behavior. It is not typically bottoming price behavior at all. And what's happened is the channel has broken to the downside. So if we then just have a run and go, wow, I've never visited Australia. It's a lovely place. I have a brother there. What's going on in there? We gave a little look. 11th month of downturn in the house makers. Now, how a property makes people feel rich. This is what frustrates me when the IMF is saying something stupid about New Zealand's strength and saying, well, they could sit through a property bust, but they couldn't sit through a corporate contraction as well as a property bust. Everything is tied together. People's wealth factor is determined by the valuation of their property. If their properties are going up in value, if your property is going up in value, people spend more. People will spend more. That means if your property start going down, those that have overspent and added on debt and are facing higher interest rates, those retailers are going to get killed. Those discretionary spending venues, holidays, everything, they're all going to get killed as the wealth factor drains away. We've had it before with the property booms in the UK, the US, etc. So the dwelling prices dropped 0.3% last month. Again, look at this negative growth, and they had 0.6 there. So they're tightening the screws, they're tightening the access to credit. And there is also a greater increase of people seeking to sell on reduced volumes of actual sales attained. So what's actually happening is more people are coming into the market. Hey, I should be cashing out. This stuff's going down. I've bought 3, 4, 5 homes. I'm letting them. I can't get the rent. They're not getting a real yield. And now the prices aren't going up anymore. I should be cashing out. Please buy it from me. Trying to hold the price, and some are slipping, as you can see. And the volumes are going down. The new money coming in is like, no. Don't want to be buying now, too pricey, credit too expensive, things on there. So what's actually happening is it's a precursor to potential ongoing downside adjustments. If we have a further Google, while we're having a look, by the way, DuckDuckGo. Yeah, use it instead of Google. Uses the same hits, but doesn't allow you to be captured and all that you are looking at monitored by the control structure. So consider that. Anyway, separate one. So hedge funds are shorting Australian retailers. So retail is a key place. If people are feeling less strong, they spend less. They eat less, they spend less on food bills, they spend less on cars, TVs, flat screens, new laptops. It's all going to be less. And what's happening? The hedge funds are shorting. So if you're a US hedge fund or you're a global hedge fund, what do you need to do? You want to sell an Australian retailer. So you have dollar-based assets. You're short selling a retailer, and you will get a certain Aussie dollar amount of cash, which you'll convert back to dollars. So people are actually leaning on discretionary expenditure, and we are seeing it for an extended period in the charts, aka this nasty grind over here, and the sell-off. Now, if we looked at that short time frame, I pointed that it's got further down to go. On the shorter time frame, we're on the monthly. You're on the. We can also show you. Let's show you a different cross. That's New Zealand, which I'll be coming to. This is the British pound versus the dollar. Now, this is Brexit central. I mean, this has just been bad news place as a currency. You know, there's nothing to be excited about having held the pound over the last 2-3 years. But let's just point this out. Clear bottoming for the pound here. The pound is first. That means it is the base currency, £1. You see it stated first in the top left corner there. And the term currency, AUD, is the Aussie. How many Aussies do you get? So weakening of the Aussie means this going up. In other words, pound strength relative to the Australian. So we have all the Brexit sell-offs that were highly destructive for the pound. over here. Let's take it right up to the monthly first. So you can see the Australian has just represented strength throughout the period. Down, down, down. The pound has gone down, down, down with the various crises, 2008, and then down, down, down through to 13. Then we began this first rally up to 2.23. So this is the narrative, a multi-decade strong period for the Australian economy, a large amount of it being based on what's going on in China, mining and commodities, and also now property, where also the Chinese money has found its way into there. So since basing out here, we've been in an uptrend. We went into a falling wedge against the pound. Remember, I'm not putting you against the strongest currency right now. I'm comparing the Australian against the pound. What's happened? The falling wedge has been triggered. There's been a breakout. Can you get a return move? Yes, you can, but that's a very determined and single-minded breakout for that week. That was a bad, bad week for the Aussie, and it wasn't special for the pound. So up you get. There she goes against the pound. So we're seeing natural weakness in the Australian currency, and we're at beginning of a major re-rating. Now, this has been a property boom that everyone has said, you're wrong, you're wrong. Everyone said that the bubble will never burst, or those that said the bubble will burst, others said you keep saying it, but it never happens. Unfortunately, it's happening. And as Harry Dent and others that have also deserved credit for work in this space, all bubbles do end with everything. If they can extend if they're given this tailwind of gifts, but eventually that tailwind dies down. And the Chinese tailwind and their level of indebtedness has also calmed down, and now the lending criteria, etc. So Australia is a slowing against currencies that are weak themselves, that have a lot of uncertainty tied to them. So we're talking about the GBP. So I suppose what is the whole narrative at a reset level? The reset narrative is that the Antipodean nations are going to have a tough time at a currency level and a tough time with a cooling of their property. New Zealand, a little bit less OTT, but they've become, wait for it, the most expensive home per income revenue. So relative to income, you need 143% of annualized income for the average home. New Zealand is the most expensive housing with the latest OECD data, Q4 of last year. Okay, so that's a little old now, because given that we're Q3 of 2018, but the data lags generally by a quarter, even to 6 months. So you've got to keep an eye out for that. But showing that the New Zealand now is the most expensive to income property. Guess what? It's gone too far. It's gone too far. And now they've banned foreign ownership. They're taking away a large component of that demand. What's going to happen? People are going to less be able to afford it. The wealth factor that was generated by this chain of events is going to diminish as those buyers are reduced, and also lenders will rein back, and you're going to have a deflation. They're hoping they can do it in a more orderly manner, I suspect, than what I would see for the Australian market, the Australian which has been allowed to get way out of tune. So if I had to choose between the two, I think the worst, hardest to fall will be the Australian, even though relatively the New Zealand market is even more expensive. It does seem that they're trying to take the steam out, and maybe they will be able to release some of that more gradually. So lending standards have got tighter. Buyers are being reduced. The Chinese buyers aren't coming at the same rate anymore after they got indebted to the level that they were, and the cycle's been extended too far. Rental yields will be well below capital values, so you still have a negative cash flow asset even if you have it fully let throughout the deflation period. So you're going to have to be paying in to keep this asset that you're not even living in. So it's like having a staff member that sits there and does nothing and apart from throw bills at you every now and then. So the big thing is currency markets are signaling it. And now just doing these Googles, we even seen play being flagged by hedge funds. Australian retailers are going to be hammered, all discretionary income. So the reset sniper prediction here is a deflating property bubble is already be commenced, and it will have knock-on effects beyond which that most tend to understand. It could even lead to certain banks coming under major duress, aka bailout in Australia. Could Australia end up having a bailout event for banks that are hyper leveraged in the domestic residential property market? Could they have those events? And yes, they will get kicked in the corporate arm as well as in the residential home mortgage arm. Why? Because everything is correlated. That discretional income, that absence of retail is going to mean corporate space needs to be released. They're not selling what they want. They want to give up space that they don't need anymore. They've got to cut salaries, cut workers, resize to survive a contracting market, and it could be tougher times for the Antipodean nations. And the reset sniper prediction is potential for banks to come under failure. Look at your weakest Australian banks and ask the question, could these guys be hand out looking for bailouts to tax the citizens of Australia and New Zealand, and ask essentially for government to give them taxpayers' money? And I think that would be outrageous. We know this playbook. It's been played out a couple of times now. And is it Australia's chance to stump up for their irresponsible banking sector while they get hit with the contraction? That's the reset sniper aspect. In terms of us, we are looking at our key trades. We're looking for a little bit of a pullback here on the GBP versus New Zealand. That's right, the pound. You're kidding me. Maybe the pound will come into some strength when the certainty is finalized. A little bit of a pullback, and then we're expecting a break here and a run to the 2.05. So we would be buyers in and around the 193 on the currency for a run to 2.05. That is the pound against the New Zealand. Yes, go have a look at other crosses if you think you can do better, but this one looks sweet. It's HVF method. Where are we short? We're short currently on the Australian dollar against the US dollar, and with that one is well on its way. You will have missed this trade. I wouldn't say chase this by any means, but that's the value of a community. We've had our guys discussing this potential trade for a while. You could have been in short from the primer if you were watching and you knew the method that we utilize. By the way, like our Facebook page, The Market Sniper, guys, I'm going to give you a free mini course, totally free mini course on 3 things that will benefit your trading. I've got other aspects that I'll include in that, and it'll be there. Like a lot of guys, I can't afford your course. I'll give you something free. Look, it's not going to be the detail that our premium guys get, but the only way we'll know if it's something for you is you go like the Facebook page, and you'll get a short little mini series that'll go out on that. So go to the Facebook page and hit like. Anyway, so it's a bit of a bear flag. It could roll over again. It could rally for a bit before rolling. It doesn't do straight line, and it has lost a lot of value, but the potential was it could have been short here. So just to show you the tools on TradingView, it's a great little technical platform, and we're big fans. We're big fans now. We're learning to use it better. He says you could have been short from there with a stop there. That would have been the entry, actually, without it even being an early entry on a primer. And your RRR, yeah, doesn't that sound funny to say quickly? It sounds like a seal. Anyway, yeah, so that would be risk reward 12 upon target being made, which hasn't happened yet. So as with anything, there's a probability-based event here that we're yet to see the final outcome on. Okay, good. A little bit of charts. Little bit of Antipodean woes. I hope the guys, if you are in Australia and New Zealand, be smart, cash up. If you run a business, get all your invoices paid, give discounts, get your front-loaded cash. People might roll over and go bad on you, higher propensity for bad debts. Hoard cash. hold other currencies apart from your own. If you have properties and you're overextended, try get out of them quickly. Maybe take a cut in your price, get out, get the sale out. Banks may fail. There could be pressure. And tenants might have an opportunity to rent real well for that. And let's just don't hold banking shares, please. And that's it. That's just entertainment, not advice, not a financially qualified advisor. Okay, with that, I love you and leave you. Goodbye for now.